Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Dr. Linda Yueh, adjunct professor of economics at the London Business School, to discuss the great crashes, lessons from global meltdowns, and how to prevent them. Dr. Yueh, it's great to have you with us. Welcome to Trade Talks.
Oh, thank you so much, Jill. Lovely to be here.
You got it. Why do financial crashes happen in the first place?
It's a great question, and they happen quite regularly. So in my book, I write about 10 great crashes over the last century, and they really happen because of I've got a three-phase framework for thinking about crashes. And it's really the first phase that seems to repeat and repeat, which is, people have this exuberant belief that prices can only go up, whether that's housing or stocks. And it's that exuberance which leads to bubbles. But where it becomes a financial crisis is if you fund that exuberance with debt. So all busts are because too much debt has funded an exuberant bubble. But it is human nature, and it is hard to tell whether something is fundamentally rising in value or if it's a bubble. So that's why financial crises occur regularly, because it is really hard to tell. Human beings are optimistic. My first lesson is I completely get that, but just make sure you don't fund it with too much debt.
Is there a particular crash in history that stands out the most to you?
Oh, there have been so many of these. I'm actually, if I may, highlight two of them because I think they're relevant to what's happening today. So the savings and loan crisis in the 1980s was actually a slow burn crisis because S&Ls were not big banks. However, the crash in the commercial real estate market meant that these banks, a third of them eventually failed. One failed at least in every US state. And it took until 1990 before the entire S&L crisis was resolved. And it was the costliest bank rescue in history. So now if you think about today, the mid-tier banks, that is a risk. The second crisis that I write about is the dot-com bubble. Now, that's the example of irrational exuberance. The stories there that I write about are just astounding to me. The guys who ran garden.com, not only did they not know gardening, they didn't even really like gardening, but everybody wanted to be a dot-com millionaire. And you can understand the exuberance, right? You can buy something online. You don't have to go to a physical store. And so private equity, venture money all piled in. And then when it burst, it led to a recession. So if you look at the tech crash today, some of the valuations I compare in my book to what was happening then, very similar. And if you look at how long it took the Nasdaq to really recover, it took 15 years after the dot-com burst in 2000, the bubble burst then. So when we're looking at what's happening now, we shouldn't be surprised that it could take some time for the valuations and for the market to sort itself out.
What do you think will spark the next big crash?
Oh, great question. So as an economist, you're advised to do one of two things: predict a crash or predict the timing, but never both. So I would say I write about the next great crash as China, not because I think it'll be the next crash or even the next crash after that, but because it is such an important economy, not just in terms of economic weight, but because of its impact on developing countries. And also it's an economy we don't know much about, really, to the same extent. And it's unusual. It's overdue for a crisis. No major economy can go for 40 years without having a major crash. So China's property market, there's been a shadow banking crisis, there's lots of different triggers there. But the impact that I write about is China is the world's biggest official lender. So that means developing countries are more indebted to China than they are to the World Bank. If China were to have a crash, it could trigger a global meltdown, which is the kind of crashes I'm trying to avoid by writing about it in my book, because crashes are inevitable. But what makes it a global meltdown is if you don't heed the second phase of all crisis, which is credibility and resolution. And Chinese policies so far haven't shown that credibility. So I am worried that if China does crash, it could be the next global meltdown. However, that being said, there's lots of other things which I'm sure will happen in the meantime. And, what I really draw on the lesson is let's learn from history. I talked about the first phase, the second phase, the third phase is the aftermath. Not every financial crisis even leads to a recession. 15 bear markets in the US since 1970, 11 recessions of varying stripes and major economies, I should say. So we just have to be sure that deleveraging is supported by policy. Policies are quick and credible. And that's how you ensure that after a crash, you don't have a disastrous aftermath that affects people for years on end.
So are we doomed to repeat the same mistakes over and over? I mean, you talk about irrational exuberance. It sounds like it's a human nature thing.
Yeah. Yeah, so I think Mark Twain is right. Mark Twain reportedly said, history doesn't repeat itself, but it does rhyme. So, given that it is human nature to be optimistic, that we could be on the cusp of a technological transformation, and of course, we have seen those through history. So you completely appreciate why it is that people today, for instance, look at AI, they look at technology breakthroughs in terms of adoption, and think, yeah, this could be a completely human nature. However. Given that we will always not be able to tell if it's fundamental or a bubble, the big lesson from my book is, invest, be wary, and importantly, have policies which do not pretend to be able to prevent every crisis, but support people and viable businesses and quickly resolve the crisis when it happens. So the example I give is actually Japan. The IMF says the first 10 months of a crisis are absolutely crucial if you want to have a decent resolution. Anything over 4 years is problematic. Japan took 8 years. So their real estate crash in the early 1990s, unlike other real estate crashes that happened in Scandinavia and in Europe and in Canada, led to lost decades of growth. So we will always have financial crises, but they do not need to be global meltdowns if we can learn the lessons from history and heed Mark Twain.
What is the 3-step framework to help spot when financial problems are brewing?
Yeah, so I write about the first phase is euphoria or exuberance. That happens a lot. So watch the amount of debt. The second phase is credibility. So I start the book with the 1929 Great Crash. So why did the Great Depression take until 1933 to turn a corner? Because FDR was credible in the way that Herbert Hoover was not. People believed him, and he was backed up by legislation, shut down the banks, that when the banks reopen, it's safer to put your cash in a bank than under your mattress. So credibility and speed are crucial. And then the third phase is the aftermath. So the aftermath depends on the extent of deleveraging, repaying debt, and the speed and credibility of the policies that support the real economy during a crash. So if you want to spot the next crisis, watch for something that looks bubbly, fueled by debt. If you want to know how it's going to play out, check out the institutions and the policymakers. Are they credible? Are they quick? Do they have the political will and the ability to support the economy when the inevitable crash happens? And then that will determine the third phase, which hopefully for most countries will be much shorter than Japan's, which is the aftermath. Doesn't have to be a recession. So 1987, Black Monday, worst one-day crash in history up until that point, had no real economic impact except on markets. And that recovered pretty quickly. So to me, that's probably the most important lesson to draw from a century of great crashes.
Yeah, and to wrap up here, the key takeaway that I took was how critical the policy response was, not only to resolve the issue, but to think about a framework moving forward. It seemed to me policy, that was the key takeaway for me.
Yeah, absolutely spot on. All the crises that I look at in the United States, in Europe, emerging markets, credibility of policy is how you prevent a bubble from building in the first place. So, in the past, and this actually comes from 1955, the Fed chairman said, who wants to take away the punch bowl when the party is getting started? Well, now policymakers will lean against the bubble and try and prevent a bubble from becoming too big. And the resolution of that, any bust, completely depends on credibility. And I would also add a final word about where individuals can, have a think about what it means for them. So, if you are thinking about piling into a asset, just make sure that you can afford it when prices come down, because that's inevitable in history. What goes up will come down. So boom and bust. And also, if you're thinking about retiring, try not to do so and crystallize any losses, because a lot of these losses on assets are actually paper losses, because the prices may well go up again. So try not to retire or take your investments out at the bottom of the market. So now you're probably thinking, well, when is that going to be? Yeah, act carefully, take advice, and but most importantly, think about when there's a bust, there will be a boom. And so position yourself and your company for the fact that it will always turn around, and try not to come out when it's the bottom of the market.
All right, Dr. Yueh, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.